Today, our look at questionable TikTok tax advice is focused on tax write-offs that sound too good to be true, mostly because they are. Let's take a look.
G-Wagons weigh more than 6,000 pounds, and that weight is one of the reasons why so many people have them.
Those 6,000 pounds qualify the car for Section 179, a rule in the IRS tax code that allows business owners to write off the car as an expense.
Normally you would write off the car over 5 years, but cars that are under Section 179, you're able to deduct the entire amount in the first year that you purchase it.
To do this, you're going to need a business like an LLC or an S Corp, and you also have to use the car for more than 50% of the time for business purposes.
You can take the deduction even if you finance the car. So you could put a $20,000 down payment, finance the remaining $150,000, yet still claim $170K in tax deduction.
So if your business made $200,000 in net income and you took the full deduction, you would be taxed as if you only made $30,000. You don't have to just get a G-Wagon either. Many other cars qualify, and here's a list.
Here's what he's telling you. Buy a vehicle that weighs over 6,000 pounds. Claim that you use it at least 50% of the time for business, and then write off 100% of the purchase price. The thing is, he's leaving out some important information. Section 179, and what's known as bonus depreciation, will allow you to deduct some or all of the vehicle's purchase price in the first year that you buy the vehicle and put it to use for the business. This works for new and used vehicles. However, there are some caveats here. First, your business must really use the vehicle 50% or more for business purposes, and you must document your business mileage and personal mileage in a detailed mileage log. Then, if your business vehicle weighs more than 6,000 pounds and you end up using it 58% of the time for business purposes, that means you only get to write off 58% of the vehicle purchase price, not 100% like these TikTokers suggest. Next, remember that a write-off or deduction doesn't mean that you get all of your money back. It just means the amount is deducted from your taxable income, so you pay less in income taxes. In other words, the IRS isn't going to give you a free car.
What's a piece of information that you learned that feels illegal to know?
That if you start an S corporation and you own 100% of your S corporation, that you can buy everything that you own under that S corporation, and then you don't pay taxes on anything that you purchase because it's considered a corporate expense. And you can take one corporate vacation a year, and depending on how much money your corporation makes, that price actually fluctuates up, and you can actually hire your children to work for you for $12,000 a year tax-free, so then you're actually showing an expense, but you're gifting it back to your own family household. And then you pay yourself a salary, which means you pay less self-employment taxes. And then basically at the end of every month, you're left with $0 to pay real taxes on. It feels really shitty to do it, but it's kind of how you avoid paying taxes. So, I don't know.
Oh man, I wish it worked this way, but like I said in my last video, if it sounds too good to be true, it probably is. The video is saying if you have an S Corp, then everything you own or buy can be expensed. Then she also says you can take one free vacation every year and hire your kids, pay them $12,000 in tax-free money. So basically, at the end of every month, you're left with $0 to pay real taxes on. This one cracks me up every time. Unfortunately, you cannot take a tax deduction on just anything that you don't specifically use for your business. Your home furnishings, your personal vehicle, your clothing, your vacations, and so forth are not tax deductions just because you happen to be a business owner. Now, the bit about hiring your child does have some truth to it. If you want more info on that and other legit deductions, I've linked my blog post for the top 10 tax saving strategies for S corporations in the description.
And I'll get to that in a second. So once your parents receive this money, you've gotten a tax deduction for paying it to them, because anytime you're an employer, you actually get to write off salary and compensation to the people that work for you. And then when you're talking to your parents, you say, okay, you're retired. You most likely don't need this money. What I need you to do is to gift me that money back. Now, if it's one parent, they can do $15,000. If it's both of your parents, they can do about $30,000 and they get to write that off. So that money comes back to you tax-free. Now, once this money gets to you, it's came from your business, it's gone to your parents have given it to your own personal bank account, not the business bank account. And then what you do is you take this money and you...
I'm not sure where to start with this one. He's basically saying you should hire your parents or put them on your board of directors, then pay them a salary and have them gift that salary back to you, and then use that tax-free gifted money to pay off your student loans. But here's the thing. If you follow this method, you would be committing tax fraud. Plus, your parents would actually have to pay income tax on that salary that they were paid, and I don't think they're going to go for that plan. So, what did you think about this round of TikTokers Gone Wild? I hope some of them gave you a good chuckle and also helped answer any questions you might have related to these tax topics. In the last video of this series, I'll be sharing one more round of really bad TikTok advice and how to make it work for you. I'll see you in the next one.